Hello, it's David Darst. We're here to bring you a review of the first quarter of 2023. There was certainly a lot to think about and to take into account when setting investment strategy and investment policy. One of the big things was the ability to ring fence the failure of three banks in the United States. You're talking about Silicon Valley Bank Corp., you're talking Signature Bank, and you're talking Silvergate Bank, which had a lot of exposure to cryptocurrencies. Secondly, the Fed expectations are in flux. The Fed raised interest rates in the United States by 425 basis points last year, 7 increases, and 2 so far this year, another 50 basis points. So with a policy rate of 4.75 to 5% here at the end of the first quarter. You've had mixed signals on inflation. You've had the producer price index has come down. The consumer price index has come down to the 5% range. It was 9% back in June of 2022. The labor market in the United States has experienced a mild softening. And finally, there's been slowing growth, and I would say in the context of slowing growth overall, globally. You've had the United States, Europe, Japan. Inflation has been on the sticky side, and China has not witnessed the similar kind of inflation and thus the similar monetary policy. Japan and European monetary policy has this basically been catching up with U.S. tightness in the monetary policy, although that tightness, as you know, is moderating. There are two important divergences right now. First divergence is what the stock market is saying, and it is basically saying there'll be growth, that the economy will not undergo a very severe recession, if at all, and things will be working out just fine. The bond market, on the other hand, with interest rates declining as they have declined as dramatically as they have in the recent months of the first quarter, the bond market is sending a message of after the Fed finishes tightening, we're going to basically go into a recession of some magnitude. So that's the first divergence. The second divergence is what the federal funds market is saying, that's financial market participants, about the course of interest rates versus what the Federal Reserve is saying. The Federal Reserve is saying we're going to basically take interest rates up probably another 25 basis points May 2nd, May 3rd at the FOMC meeting, Federal Open Market Committee meeting on May 2nd, May 3rd. The federal funds, and we're going to take them up to 5.25, and then we're going to keep it that way through the end of the year, and only begin cutting early 2024. We also believe that that's a reasonable assumption. That's a reasonable assumption. However, Fed funds futures markets are expecting 3 or 4 interest rate cuts during the course of 2023 as we get into this more recessionary circumstances, and ending up this year more closer to 4 rather than closer to 5, which is the Fed. So you got the divergence there between the financial market participants and what the Fed is saying. We basically see financial asset prices right here as essentially range bound. For the S&P 500, to take one example, it's been trading at a range of 3,900, 3,800 to 4,200 for most of the first quarter. The market has been led up by the top 6 stocks: Apple, Microsoft, NVIDIA, Amazon, Meta, and Google. Those are the big 6 we're talking about. The rally drivers so far in the first quarter have been the fact that this bank crisis did not become badly spreading all through the economy. Secondly, you've had better than expected corporate earnings. You take Micron Technologies, you take Lululemon, you take JP Morgan, many of these companies have reported earnings, and often before earnings season begins, and it begins in mid-April, as you know. Often before the earnings season begins, you will have companies give pre-announcements. And often they pre-announce when it's going to be disappointing. Instead, the pre-announcements have been 81 of the pre-announcements have been positive pre-announcements, and only 22 have been negative pre-announcements. Usually it's about 50-50. So basically, I think that's a second reason that the market has been wanting to lift so far in the first quarter. February, you had a big decline in interest rates. The 2-year interest rate fell by 75 basis points. The 10-year fell by 40 basis points. And that also lifted the valuation of these big six super cap companies: Apple, Microsoft, NVIDIA, Amazon, Meta, and Google. Those are the big six we're talking about. The areas of focus that we want you to be thinking about, and that we're thinking about: will the banks curtail credit as a result of what developed with this Silicon Valley Bank Corp? They're all looking at their books. They're looking at their loan books. They're looking at their assets, and they're looking at the flow of deposits. Will the Fed cut rates before year end? That's the second area of focus that we're spending time on. The depth and duration of the recession. We think it will be a recession sometime as growth continues to slow in the United States. And the course of inflation after the OPEC plus production cutback, which led to a rise in oil prices, how will that affect things? And finally, very importantly, in terms of equity markets and investor psychology, how are corporate earnings going to turn out? We will follow this as we go through the second quarter, and we will begin in July. Mid-July, you'll start to get people reporting the second quarter, not the first quarter, and then investors and analysts begin to look over into 2024 earnings. Right now, 2023 earnings are supposed to be about $225. And with the end of quarter S&P something around 4,091, that works out to about an 18.2 price earnings ratio, which looks a bit rich to us from a valuation standpoint, given the slowing growth, given some of the geopolitical concerns, and given some of the continued likelihood of interest rates maybe being lifted one more time before the Fed halts and pauses. So a rich price earnings ratio. We think also the dollar is probably going to be subject to some further weakness. It was very, very strong last year, the year before, but it's come down, maybe down 1%, the big DXY index. So pulling all of this together, we are recommending to clients to focus on private credit, real estate debt, also some private equity. This is a time to use these low volatility, good return assets, private credit, private real estate, and long short equities in the liquid area. Good managers who can adopt long and short positions. With that, we want to wish everyone a great quarter ahead. Thank you for being with us today. Godspeed, Excelsior, and Ramadan Mubarak.